What is your magic number? Do you know what it is? We're talking about how much money that you need to provide a lifestyle that you're accustomed to once you retire. Hopefully you don't actually need a magician to create this magic number for you. Stick around, we'll show you the steps to make sure that you can ensure a wonderful retirement. Good morning, everyone. Joe Anderson here, certified financial planner, president of Pure Financial Advisors. And of course, this show just wouldn't be a show without the big man. That's Big Al Clopine. He's sitting right over there. We're going to use the big brain on Big Al, and maybe he can pull a rabbit out of his hat to create the magic number that we're all looking for. Because when it comes time to retirement, do you actually know how much money that you need saved? Some of you, this is going to be a great show. For others, it might put a little worry in you, but don't worry about it. We'll figure it out. That is today's Financial Focus. Hey, a lot of factors that you have to consider in regards to retirement. This magic number that everyone is searching for, is it $1 million? Is it $2 million? Is it $5 million? Or is it only $50,000? Take a look at your pensions, how much money that you have in fixed income, such as pension, Social Security. Then take a look at how much that you're actually spending on a monthly basis. And be honest with yourself. A lot of you always a little bit think that you're not spending as much as you are. Then take a look at life expectancy, how long you're actually going to live. Then take a look at your investments. And last but not least, how are those investments going to be taxed? Because if you've ever watched this show, we're big fans of tax diversification, because if you can mitigate the tax, that money is going to stretch a little bit longer. And speaking of tax, let's bring in the star of the show, Big Al Clopine. Alan, magic number.
It's time to create some magic, and what a better person and format to do it, huh?
Well, you know, I think it's people don't know how much that they actually need. And so I think this is a very important show to really help people understand, hey, you know, that $100,000 that you saved, that's a lot of money, but is that going to last you the next 20, 30, 40 years potentially to create the income that you need?
Well, Joe, I think there's a lot of confusion on how much you really do need to save. So I think what we're going to do is try to demystify that for you, to show you what is your magic number, because there's different ways to calculate it. And right off the bat, we're going to talk about probably what everybody's goal should be, which is saving 15% of your salary. And trying to do that as young as you can, it can make a really big difference. But more than that is, as you get older, let's find a way to see if you're on track. Fidelity did a study of different factors. In other words, your salary times a factor at various ages to determine if you're on track. And finally, we'll get into the 4% distribution rule, which is not new. It's been around for a while. But we're going to really show you how to use it effectively, because a lot of people kind of, there's a lot of factors here that you need to consider to get that right. And Joe, it's what a better topic than, I mean, everyone wants to know, can they retire? And everyone has a different magic number, but you know,
well, I mean,
how do you calculate
we got to first take a look at this is just rules of thumb. You know what I mean?
Right.
When you take a look at, well, how much money should you be saving? 15%. Well, you know what? If you could save 30%, please save 30%. But if you look at the savings rate is abysmal. Most people are not saving nearly as enough as they should. So what we're going to go through is some guidelines, is really to say, all right, well, if you did save 15% of your salary, what does that look like? You know, if you have 20 years, if your annual salary is $100,000, you got that $15,000 of savings. If you get a 7% growth rate, well, at retirement, you got $600,000. That is a good chunk of money. Now, of course, the time value of money is key. If you start early, if you got 30 years, making that $100,000 out, who came up with these assumptions? Right out of college, you're making $100,000 a year. So we're living in fantasy land already. But it's just illustrating the compound interest of a longer period of time if you can save 15%.
Well, that is true, Joe. It's you're probably not going to make $100,000 out of college.
Well, you did. You made like $250.
I think I made minimum wage.
You got a big wallet on Big Al.
But at any rate, and part of the thinking there is that even if you start at age 35 and you got 30 years to retire, you can actually do those kind of numbers. But let's take your own situation. Let's say you're 45 years old right now. How much should you have in retirement savings? Well, something like about 4 times your salary. So $100,000, you ought to have about $400,000 in savings. If you're 60, well, maybe that's 8 times and so forth. So this is kind of a good test. This was done by Fidelity, Joe, a couple years ago on what these ages should be. And it's not, again, these are just rules of thumb.
It's a wake-up call. I think
Right.
a lot of you are watching this and you're like, okay, well, here, I'm 50 years old, 60 years old. Am I on track? I mean, I'm not sure what calculation that I should use to see if I'm on track. Am I keeping up with the Joneses? Alan, I see hundreds of you, and it's always like, well, is my situation pretty similar to a lot of people my age? Well, if you use that formula, you take your age, or your age plus your income, and then that's going to come up with a factor to see if you're on track for retirement. So if you look at, all right, if you're 50 years old, and again, we're using $100,000 because the math is really easy. Well, 6 times that, right? There's 600,000. Al likes to circle 40.
I like to circle
right there.
the wrong one.
You just circle whatever you want, brother.
And then
right?
also I want to circle that.
And then at 60 years old, okay, so now you're close to retirement. 8 times, folks. 8 times is where you need to be. $800,000. I know that is a big number, but this at least can get you motivated to say, you know what? Hey, I need to get savings here. I need to start taking a look at, hey, if I'm 60 years old, I'm knocking on retirement store. How much money am I making? Times that by 8. And do I have that in liquid assets? Is that your 401ks, IRAs, mutual funds, and things like that? But again, of course, there's other factors here. You have to take a look at, hey, do you have a pension? What is that pension income going to be? Because if your pension's paying you $60,000 and you're spending $50,000, you are financially independent. Right? Then you just have to worry about taxes and inflation. But for a lot of people, right, you need to have this nest egg to provide you with the income that you're accustomed to now. So again, these are just guidelines to at least to ensure to see, hey, am I on track or not on track? And I think that helps people to say, you know what, I'm close, I'm right there, or hey, I got a lot of work to do.
Yeah, and Joe, I think a lot of times when we do a show like this, people that haven't saved, they know they're behind, and they tend to tune us out because
they already turned the station.
They feel embarrassed. But what if you're 60 years old and you really haven't saved anything? So let's take a look at that example. So if you're 60, you probably want to work till at least 70, right? And so maybe you got a 401k, and think about maxing that 401k. That's $24,000 a year. I know that's a lot, but if you'll do that, and let's just say there's a company match of about $3,000, at 7% rate of return, you end up with $373,000, which, by the way, is well ahead of the averages. And this is somebody that age 60 hasn't saved a penny.
Right. And then if you wait until age 70, of course, your Social Security benefit is going to increase unless you took it early. But hopefully, if you're still working, right, I'm going to work until 70. I'm going to max out my savings over the next 10 years. Hopefully, I get a company match. You get 7%. Now you have close to $400,000. Plus, you have a lot higher Social Security benefit. Maybe that benefit is $20,000 plus you taking distributions. $40,000, $50,000 income, 70, until end of life. That's not bad. You're right there. If you started from scratch at age 60. So, I mean, I think people upon hopelessness, I'm going to work until I drop. Hopefully that's not the case. Hey, we got a lot more to go, so don't go anywhere. We're going to talk about some different rules of thumb that you can do to really fine-tune this magic number. Good morning, everyone. Show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Big Al hanging out, talking about your magic number. How much money do you need to accumulate to provide yourself with an income that you need for the rest of your life? Before we dive into more of the nitty-gritty, let's see how you did on the true-false.
I should not include Social Security benefits when I calculate my future retirement income because the Social Security Administration is running out of money. We get that question, true, false, all the time.
Loaded.
I'm going to say false, Joe.
I'm going to say true.
Okay, good. I'm going to say false because
Well, you're a lot older than me.
it'll work for
You're
me.
going to take all the money.
Maybe not you. You know what? The last I heard was Social Security Administration was supposed to be like running out of money somewhere between 2034, 2037. That doesn't mean there's no benefits at all. That just means that your benefits that you receive would be cut by about 25%, give or take, right?
20%.
But on the other hand, there's a lot of ways to fix Social Security, Joe. You can increase the retirement age, which they've actually done twice. You can increase the contribution amount. You can increase the limit amount. I don't think it's going to be that difficult to save Social Security. I will say one thing, though. They could add means testing. So if you got a lot of assets or a lot of income, you may not get your full benefit.
Yeah, I would say that's probably coming down the pike. Means testing means, if you have more assets, right? If you have a pension or a lot of money already saved up, they might shrink your benefits. So there's probably different claiming strategies for a lot of different people. So Social Security, interesting topic.
It is, and it's.
Let's get political.
What the hell? It's more complicated than it should be.
Can I answer
Actually,
this question?
No, you didn't even touch on it. I want to switch topics, Joe. Though I want to get into the countdown for retirement. This is when Joe gets a question from a viewer that he has not seen, so he's got to answer it off the top of his head. Here we go.
Hi, Joe. My question is basically I'll be turning 70 early next year, and I've been thinking about this Roth conversion and if there's any new strategies I should be thinking about with the new Trump presidency, if there's anything that might be helpful for me. Thank you.
All right, so the question is that he's turning 70 years old and he's looking at Roth conversions. First of all, a Roth IRA conversion is taking money that you have an existing retirement account and converting that into a Roth IRA. You pay tax when you do the conversion, but then all of those dollars grow 100% tax-free. When you turn 70, there's a couple of things that you want to be aware of. You have a required distribution. So you have to take the distribution out first, pay tax on that. You can still do Roth IRA conversions, but you cannot convert your required minimum distribution. Now, in regards to the new administration, when it comes to tax reform and anything else, I have not heard of anything about changing the rules when it comes to a Roth IRA or Roth conversion. In my opinion, Roth IRAs and the Roth conversion is the golden goose of tax planning because it really benefits us, the consumer, and it also benefits Washington, D.C. because they get their taxes now. Do the conversion, buddy. Boom, right there.
Agree with that. And I would add one thing, maybe, perhaps, with the Trump administration. There's a lot of talk about lowering the tax rates, and if that actually happens, then the tax on your Roth conversions will be even less. It'll be even cheaper. So watch out for that. Joe, I think the next thing we kind of want to get into is that 4% rule. And it really is kind of just a rule of thumb, but I want to show you how this is computed. You want to start with your desired retirement spending. In this example, it's about $80,000. Okay, now let's look at your fixed income, your retirement income. Social Security, $30,000, pension, $20,000, so that adds up to $50,000. Let's compare those two. Whoops, we're short. We're short by about $30,000, right? So that's what we're going to have to produce from our investments. So simply take that number, multiply it by 25, and you end up with $750,000. That's roughly what you would need in your savings to be able to produce $30,000 of income for about 25 years. That's where this 4% rule comes from. So this really works well when you are close to retirement. And Joe, I mean, if you're 20 years old, this makes no sense. But if you're 60 and about to retire, this can make a lot of sense. Taking a look at this and figuring out, have I saved enough to be able to retire?
Well, here's my thought on this 4% rule. It will help you determine how big of a nest egg that you actually need on your retirement date. After that, I don't think it has any merit. All right, because there's so many different factors that are going to affect your life after you start taking distributions. But I disagree with Alan saying, hey, if I'm 20 years old or 30 years old, and if I'm looking at, hey, I want to spend $80,000 today, I can inflate that $80,000 through my retirement date of 40 years, and then that might be $150,000, take my fixed income. It's the same mathematics. And then I'm going to look, all right, well, now I need $2 million to do the things that I want to do in 20, 30 years from now. So then that can get me into savings planning today. But a lot of people that watch this program are a little bit older. And they're like, all right, well, here, I'm knocking on retirement door. This is a very good exercise to say, all right, do I have enough assets? Then you can get really fine-tuned on this because it's your desired retirement income spending. You know what your Social Security number is. You know what your pension number is. You subtract those two from your spending, times it by 25, that's your number. Now, if you're close to that, hey, congratulations. If not, you're going to have to toggle a couple of things. Reduce your spending, try to increase your fixed income. There's a lot of different levers, basically, that you can pull as you get closer to that retirement date.
Yeah, no question about that. And something else that you need to realize is when you retire is going to affect your distribution rates. And we have an example of this. So if you retire, let's just say at age 55 years of age, then that means you're probably going to want to have a lower distribution rate. So in our example here, it's about a 3.3% distribution rate. And that, by the way, this comes from Wade Pfau and others that have done all kinds of studies.
And again, what that means is you don't want to pull out any more than 3.3% out of your portfolio.
Yeah, exactly. So in this example, your $30,000 shortfall, you probably need about $909,000 in this example to be able to generate $30,000, right, for about 35 years of age.
Right, so $909,000. You take 3.3% of 909,000 equals 30 grand.
That's exactly right. Now, if you're 65, it's that 4% rule that we're talking about. Now you're looking at about 750,000 needed. But what if you retire later? Let's say age 75. You can probably take more assets. You take more income out of your portfolio, right? Because you're not going to live as long. So in that case, maybe you only need $500,000 or $600,000 to be able to pull this off. So realize this: that 4% rule. It's always just a start. And gosh, there's so many factors, but age is when you retire is certainly one of them.
Right. Again, this is that distribution rule is that if you have $100,000 and you don't want to pull out any more than 4%, you don't want to pull out any more than $4,000. The big brain on Al, he's re-engineering it to figure out exactly how big of a nest egg that you need. And then when you take that 4% or 3.3 or 5.3 or whatever that number is, then that can tell you what your nest egg is. So it gets a little bit complicated. But we're just trying to show you some different rules of thumb. As you get older, you can start adjusting your distribution rate as well.
Yeah, and there's other factors too, Joe. For example, if you're very conservative in your portfolio, in other words, you get lower investment returns, you're going to have to decrease that distribution rate. Or on the other hand, if you have impaired life expectancy, if you don't think you're going to live as long as average, maybe you can increase that, although be careful with that one. If most of your assets are in retirement accounts, you're going to pay high taxes in the future. You might need to decrease that, but if most assets are in Roth or trust accounts, you've got tax-free and capital gain income. So now really you're looking at a better tax rate. So those are just some of the factors. Remember, when we're showing you distribution rates, this is just a starting point. But Joe, in a lot of cases, people don't even have a starting point. Where to even start with this?
Right. It's like, all right, well, here, I'm looking at retirement next year. Right, I want to spend $150,000 a year, right? I really want to live high on the hog. Then we'll ask them, all right, well, how much money do you have? They'll say, well, I have $300,000. And then we'll say, have a good 2 years. You're done, right? The mathematics don't work out. Because if you think, hey, well, the stock market has generated a 10% rate of return from 1927, and if I have a full stock portfolio, can't I take 10% out of my portfolio? No, it doesn't work that way because the 10% doesn't hit your account every single year. It's the sequence of returns that means everything. And even more importantly, too, when you take a combination approach to create your income, you have to look at taxes. You really do. And a lot of us have all of our money or most of our liquid assets in retirement accounts, in these 401ks, 403bs, TSPs accounts, right? Every dollar that comes out of there is going to be taxed just like your income today, right? Full federal, full state tax if you live here in Southern Cal or in the state of California. But if you have money in a Roth account, right, then that's going to be tax-free to you. Or if you have municipal bonds, the income or interest or coupon that those bonds deliver is going to be 100% tax-free. And then if you have assets outside of your retirement accounts, well, those are going to be taxed as a capital gains rate in most cases. So now it's looking at, hey, do I have diversification not only in my investment strategy, but also in my tax strategy? Then when you combine these, then that's going to help with your Social Security claiming strategy and then your wealth transfer strategy and everything else in between. I mean, that's why I think working with a CPA and a CFP is so key, because your taxes are going to affect your investments, and your investments are going to affect your taxes and your estate plan and your cash flow and everything else. So make sure that you map all this stuff out and do not ignore taxes. Hey, we got to take another quick break. When we get back, it is the best part of the show. That means we're going to flip the show back to you and answer your email questions in just a second. We'll be back in a moment. See you later. Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson here, certified financial planner with the Big Al Clopine. We're talking about your magic number. And if you watch this show, there's nothing magical about it. All you have to do is a little bit of planning and kind of figure out exactly what you want to do, and then just implement the strategy. Before we wrap this show up, let's go to the true-false.
Older savers have an advantage when it comes to saving for retirement because they are allowed to put more money into their retirement accounts. Joe, that's a little bit of a trick question. I would say it's true and false. It's true.
False.
It's true from the standpoint that older people can't save more money because there's a catch-up provision.
Yeah, all you older people have such bigger advantages.
So in other words, when you are below 50, you can put $18,000 into a 401k. When you're above 50, it's $24,000. IRA, if you're younger, under 50, you can put $5,500 into an IRA. If you're older, it's $6,500. But why is it false, Joe, as well?
Well, I mean, the reason why the catch-up is there, Alan, is because a lot of individuals haven't saved enough money.
Yeah, they have less time, right?
They have less time, so they're like, if you just saved a couple of dollars in your 20s, you wouldn't necessarily need the catch-up provision because you would have already accumulated enough assets. But because time, right, builds up assets, and if you're in your 50s and 60s, that time is shorter. So the IRS says, all right, well, we'll give you a little bit more to save into. So, yeah, I mean, there's some favorable treatment, but I think it's well-deserved. I mean, I think, right, we need to save more. So, God bless you, Big Al, right?
All right,
Big
Joe,
Al's, he's getting up there in age, folks. He's got a big birthday coming up for Big Al.
I do. It's going to be great, too. Let's kind of summarize the show, Joe. Finding your magic number. I think at any age, a good goal is to save 15% of your salary. And as Joe said earlier in the show, if you can save more than that, go for it. That's great. But a lot of you are saving less than that. Try to get up to that level. And then Fidelity came up with kind of a ballpark of where you should be at different ages. For example, by the time you get to age 67 or perhaps retirement age, they suggest you should have 10 times your salary. And there's a chart that kind of shows the amount at different ages. So take a look at that. And finally, we talked about calculating your required savings, your magic number, by looking at your retirement expenses, subtracting out your retirement income like Social Security pension. You have a shortfall, multiply that shortfall by 25, and that gives you approximately how much you should have saved.
All right, let's turn the show to you. Let's go to the email bag.
First question from Susie in Mira Mesa. My business is having an off year, so I can't contribute to my retirement account. Is there an advantage to converting money in my current account to a Roth IRA this year? Well, Susie, great question. I'll tell you what, I guess what we're saying is your business is down, maybe your income is down. You might be in a lower tax bracket, so if you have the means to pay the tax on the conversion, go for it. The problem is a lot of times when business owners have a down year, they don't have the money to pay the tax on the conversion. But you do want to take advantage of that low tax bracket on your Roth conversion if possible. So yes, if you can.
Yeah, I mean, I think too with small business owners, right, if you're having a bad year, you could have negative income. We've seen that before, right, where your expenses, right, are a lot larger than your overall income, and then you got your deductions and exclusions. So there could be some room in that tax bracket to convert money again from an IRA to a Roth IRA or a retirement account to a Roth IRA and virtually pay zero tax. So if you have a net operating loss and things like that. So yeah, definitely take a look to see if it makes sense. And you know what? If you convert it, don't have the money to pay the tax, you can always recharacterize it and put it right back into the retirement account without any issues. Alan, we had so many emails, and we just
got to one, right?
We just got to one. You know what we got to do? We just got to have a full show.
Of emails.
It's just the email bag.
We have probably 100 that we haven't gotten to.
100, yes.
In fact, every week we have
show possible.
We have 3 or 4 or 5 ready. We do 1 or 2. So
yeah,
there you go.
We got like 50 in the can right now.
Let's go.
Let's just keep rolling this show over and over. Hey, join us next week, because it's going to be another fabulous show of Your Money, Your Wealth. We're going to talk about probably investments, taxes, retirement, maybe Social Security in there too. So if you're in retirement mode or if you're thinking about it, join us next week. It's going to be a good time. Hell of a job, buddy.
Yeah, you too.
Great job.